My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Let's make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Get this. We are at a very tricky moment in the business cycle. It's the gut-wrench time where the brown shoots we were looking for turned into the compost of an economic slowdown. It has to happen. And you know what? It's actually going to end up being good news because it means the Fed can start cutting rates sooner than expected. But it still hurts.
The house of pain.
That's why I want to walk you through the pain you're going to experience if you have that diversified portfolio. And if you watch Mad Money, I know you do. We can provide you with some Novocaine. There'll be anesthesia. And yes, there'll be up days like today where the Dow gained 32 points. S&P advanced 0.13%. NASDAQ dipped 0.1%. But you need to expect and anticipate vicious intraday sell-offs like we had today as the Fed plays coy and we await their next move. Or to put it simply, the Fed needs to cut rates because the economy's running out of gas, and that changes the kind of stocks that can work here, at least in the short term. And some very good companies will be left behind, taking their stocks down with them. Today, for example, one of the single best performing stocks, one we've been monitoring for a long time because it's incredible, several years now, is a company called Builders FirstSource. They just built one in Brooklyn. It's dynamite. They dropped a bomb on shareholders today and sent the stock down 19%. This is a major supplier to the home builders, and the story they told on their earnings call wasn't great. It always is, so this was a shocker. Listen to this, and I'm quoting. Early momentum in single-family has slowed as persistent inflation has cooled short-term expectations for interest rate reduction. Let's see, what are they really saying here? Slowdown alert? There's more. Quote, low existing home inventories and pent-up demand provide an environment where growth has continued to build. Builders across the board are having to navigate affordability issues and challenges with the regulatory environment, land development, and infrastructure, end quote. Okay, now on the surface, you're thinking, what is Cramer talking about? This couldn't have possibly knocked the stock down 19%. There's nothing in here that could do that, correct? Wrong! Because the language is all in code, so let's break it down. Let's parse it. I'll do the code breaking. First, early momentum in single-family homes slowed. You know what that means? It means there were a lot of sales when people thought interest rates were going down. But then the economy surprisingly went on a hot streak, long rates rebounded, and home builders pulled back from buying goods at builders' force that they needed to build new homes. Next, persistent inflation has cooled short-term expectations for interest rate reductions. This is key. Remember, a couple of months ago, people were wondering if the Fed stopped raising rates too soon because inflation was still too high. As long as inflation doesn't come down, we're not going to get the rate cuts. Until last Friday's weaker employment number, there was a budding consensus that the Fed may even have to raise rates. Gets worse. Builders across the board are having to navigate affordability issues. Translation. Our customers, the home builders, have raised prices too high unless rates come down. And since rates haven't come down, there'll be less construction. Less construction, less business for builders. As for the challenges in the regulatory environment and land development infrastructure, that's boilerplate. The home builders need to deal with these problems all the time. It just hasn't mattered for a while because mortgage rates were low enough that the industry didn't need to care. So now let me give you the full Builders FirstSource translation. Last quarter, we had to deal with the fact that inflation, which we thought was dead, remains very much alive. Our customers, the home builders, put up too many homes when they expected rate cuts, and these houses might not get sold until rates come back down. And that's what obliterated the stock. That's what took it down 19%. But when you see this kind of weakness, you have to ask yourself, what would happen if the Fed were to suddenly start cutting rates? Well, I'll tell you what, this stock would soar. Put it on your shopping list. But that's why I say it's crunch time. Today's sellers are reacting to a quarter where long rates spiked and the Fed didn't cut short rates. But that's now in the rearview mirror. The moment it looks like the Fed's going to cut, guess what? This becomes the number one buy. Now let's talk about my favorite steel company, Nucor. Because of all the infrastructure spending and data center build-out and even the strength of the auditors, the Nucor stock has just been a horse. Yesterday, though, we learned that just one grade of steel, it's called hot rolled steel, fell from $825 per ton to $760 per ton. That's what happens at the top of the steel cycle. That's how it starts, the rollover, the brown shoots for steel. Because this kind of steel goes into autos, energy, ag, machinery, heavy equipment, and transportation. Steel pricing had remained strong for ages. No more. That data point confirms why this stock has fallen from 203 to 171. Makes sense, doesn't it? Sure, but only until the Fed comes to the rescue. But until then, even as I think that Nucor, the company, is sensational, I know the stock is going to be hostage to steel price cuts, and therefore maybe even more cuts from Nucor stock. Disney stock cratered today. It was awful. It's plummeted down 9.5%. Why? Oh, I can give you all sorts of nonsense, but I'm going to cut right to the paragraph that did it. And I quote, as it relates to demand, while consumers continue to travel in record numbers and we are still seeing healthy demand, we are seeing some evidence of a global moderation from peak post-COVID travel, end quote. Ow! They basically said the post-pandemic travel boom might be ending. Do you know what? Last week, Booking Holdings reported, and they said the same thing about the U.S. traveler. Now Disney's being hurt by it. No wonder the stock can't catch a break. Is it a buy? Charitable Trust owns it. We saw it a lot higher. We're debating whether to buy it back. Now, sometimes it's so hard to see through this stuff because the code is so thick. Ferrari, one of the great stocks of this year, right? Symbol race, can't beat that. Quarter after quarter after quarter. That is until today, when the car company gave tepid guidance. Why? One word. Normalization. Sounds neutral, but it's code for something that is very ugly. When Ferrari said their forecast is for normalization, it means that things were really smoking, the company was over-earning, and that was now over, and business was booming, and now it's not. It's going back to normal. Normalization. Where else did we see that? W.K. Kellogg, the cereal company. Listen to this, quote, shipment volume also benefited from an increase in retail inventory versus last year, which we expect to normalize in the second quarter. Normalize. Translation, the stores are stuck with a lot of cereal, so we aren't going to be able to make our Frosted Flakes numbers until they work off the excess inventory. Or in real terms, we're going to miss the next quarter. Now, there are two ways to approach this particular moment. And I have been in this moment many times in the last 40 years. One is to ride it out, knowing that the Fed cavalry will be coming. It'll probably be here sooner than we think because the brown shoots are sprouting everywhere now. Another way, though, is to find the stocks with growth stories that don't depend on the broader economy and overweight them for the moment. I'll give you a couple because I'm a nice guy. I like Merck and now Pfizer for their anti-cancer franchises. Merck's about Keytruda, perhaps the greatest selling drug of all time. Pfizer's now beginning to get stuff out of Seagen, the old Seattle Genetics. Plus, you got that nice yield. Or, you know what, just go buy Eli Lilly. It's got the GLP-1s, and it can make all that you want. What was that with the Amgen the other day? I forget. This is the way the Charitable Trust is playing it, by the way. In terms of secular growth, stick with the big dogs, please. Don't overthink it. People always want to overthink it. It's NVIDIA, it's Amazon, it's Alphabet, Meta, and Apple. Ooh, NVIDIA reports the 22nd. I'm really shaking. These all have very good stories that don't rely on rate cuts from the Fed. Maybe consider Reddit, by the way, after tonight's beautiful set of numbers. You know what we're going to do? We're going to talk to the CEO, and if you feel like I do, maybe that's the one to buy. For people who want to ride through the valley of the shadow of the Fed, I suggest you own some stocks that will soar with rate cuts, meaning they'll be agonizing to own until J. Powell rides to the rescue. At the same time, take some laughing gas with Amazon, Alphabet, Apple, Meta, or NVIDIA, and some general anesthesia with the drug stocks, but they're the kind of stock equivalent of Xanax, but not Seroquel. If you put all your money in stocks that need rate cuts to win, you will be slaughtered. But if you go all tech and drugs, you'll be left in the dust when the Fed finally starts cutting. So let me give you the bottom line. I'm not telling you to relax. I don't do that on this show. Not with the averages so close to all-time highs. Therefore, it's a little precarious. I'm just saying we are going to the valley of the shadow of death here, and you should fear no evil as long as you have a balanced portfolio. Ralph in New York. Ralph.
Yeah, hi, how you doing? I was just thinking, Nike's down around 45% from its top of the last 3 years. They should wake up and take over Lululemon. I know it's fallen by around a third now. Looks like a discount to me. How about you, Jim?
Well, Lululemon's still expensive, and I know they want to stay independent. It's kind of an interesting idea. In a kind of a perfect world, that would happen. But we're not in a perfect world. In the world we are in, though, I think Nike's very cheap. How about that? Okay, let's go to VJ in California. VJ.
Good afternoon, Jim. This is VJ. I'm calling regarding ExxonMobil. I have 3,400 shares. Pioneer Natural was the one I was invested in. It got bought out, and I got 3,400 shares. They're giving a dividend on 5/14. 5/15 is record date. 5/16, I can sell it. I'm wondering if I'm making the right decision if I sell ExxonMobil and buy ET, MPLX, or Halliburton.
Oh, you make it so hard on me because the first two, I like those dividends. ET and MPLX have fabulous dividends. But you know what? Here's what you're going to do. You're going to sell a quarter of the Exxon and put it in ET, and a quarter in MPLX. Don't do the HAL. You don't get the dividend. Keep the other half with Exxon, and you're going to do terrifically. And thank you for the call. We are walking into the valley of the shadow of the Fed, but you should fear no evil as long as you have a balanced portfolio. Well, man, tonight, Palo Alto Networks is hosting a conference focusing on the intersection of artificial intelligence, cybersecurity, and Keanu Reeves. I'm hearing how the company continues to innovate for a rapidly changing landscape. My exclusive with the CEO. Then Logitech's bounced off its recent lows. I don't know. We got to cover this one. I love their toys, but remember, they're much more than toys. Let's get the latest from the company's top brass. And Reddit. Now, how about this? First publicly traded quarter. They gave me the quarter I thought I would get a year from now. So ask me anything. And am I one of those? Never mind. Let's dig into all the numbers. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.